My name is Michael Guyette, publisher of the Lead Lag Report. Joining you for the hour is Mark Rossano. Mark, you have a really interesting background. I know we're going to talk about all things related to inflation, food, and kind of get into the macro. But introduce yourself. Who are you? How'd you get involved in markets? And what are you doing now?
Sure, I appreciate having me on. Hopefully, we have a lot to talk about, so I won't take too long. I started at Morgan Stanley in '06, doing FX rates, commodities, global infrastructure. Looked at things on a global macro level, owned everything from physical assets all the way down to the paper, especially on the commodity front. Lived in the Middle East for a time. After that, working in Masdar City in Abu Dhabi, doing short cycle gas turbines, wind, solar, geothermal, figuring out what was the right mix. That then moved me over to Qatar, where I did a lot on the LNG and helium front, when they were looking to expand. Then into Riyadh, where I did a lot on helping them move from piped gas, from fuel oil to piped gas, and then did a quick stint helping the U.S. military figure out how to get gasoline and diesel into some far off places and the right ways to source it. And then, funny enough, trying to help NATO get off of Russian Urals. Then I ran a portfolio where I went over and I created what I call well to wheel, following the hydrocarbon from the wellhead to the end user, doing a lot in terms of downstream refining, petrochemicals, and then living in the commodity world as well, doing a lot on the pet chem, moving into fertilizers and back into the commodity on the softs. Did that, made a call that OPEC was going to go into a price war, went into a price war, followed it down the cycle, did a lot on the distressed debt, high yield front, private equity from that side. And then when I decided to start my own thing, I thought the public markets were criminal. I thought there was a lot of liquidity sloshing around back in 2019, and the world is short energy infrastructure. And so the idea was to create a private equity fund where we can invest in energy infrastructure across three buckets. One of them, base load power with a laser focus on hydroelectric capacity. Another is food and fertilizer, and finding ways to address the global food shortage, making fertilizers that are not only renewable, but also cheaper than the alternative, more efficient, and actually rejuvenate the soil instead of degrade it further. And then the other is on the renewable diesel front, just because, good luck trying to get a new oil refiner built in North America. And we're not looking for any distillate heavy crudes anytime soon. So we wanted to find something that took ag waste and forestry waste, just because biodiesel has a lot of issues with it. Water separation, water contact, it has to be blended. Again, back to the food to fuel. Why are we going to take food, turn it into fuel? So sticking with trying to take waste that was already there and creating renewable diesel.
How complex is understanding sort of the back end, the chemistry? You kind of alluded to it just there, but I have to assume that that's why there's this, as you kind of noted it, infrastructure shortage. It's also there's a degree of complexity that's hard to really learn from in a course.
Absolutely. And when you look at the build out and the technology, the problem is, and if you go back through the early 2000s on, we were at the infancy of it, where we were trying to figure things out. We were trying to see what made the most sense, bringing down costs, understanding the different economics. Should we have high pressure, low heat? Should we have low pressure, high heat? What would create the best backstop to utilize a lot of this waste that is sitting there? And then it's a matter of, well, where's the market? If let's be fair, if diesel's $1.50, you don't need renewable diesel. Like you have to see the prices go up and then become more competitive. So as prices go up, your costs come down. All of a sudden you meet in the middle, and it makes a lot of sense given the backdrop we're currently in, given the diesel shortages in the world today, the lack of distillate heavy crudes that are being explored, and just the lack of refining capacity that sits in the Western Hemisphere.
And it's that, correct me wrong, it's that refining capacity that's really where the shortages, in quotes, shortages come from, right? I mean, there's ample commodities, there's ample things. It's just more the refining and processing of it.
So there's two pieces to it, because not every crude is created equal. And so each type of oil is going to yield a different amount of gasoline, a different amount of diesel. Typically, if you want to look at the organic chemistry of it, for those out there, for every 1 barrel of diesel, you inherently create 2 barrels of gasoline. But you can mix that up a bit and increase the distillate heavy side. The problem is distillate heavy crudes come from oil sands, comes from Venezuela, comes from the Gulf of Mexico, the Alaskan slope, places that we either have sanctions on, we are no longer exploring, married with, to your point, on the refining front, where if you look in June of 2019, when the Philadelphia refiner exploded, I mean, you took 460,000 barrels a day out of the market. That's a real number. And now we're starting to see some of these other facilities turn on, but you have to consider, where are they being built? The Middle East. And don't get me wrong, you can say a lot of things about Saudi Aramco, you can say a lot of things about Kuwait. They do a really good job of building infrastructure. They are using US technology, US E&Cs. So we know the quality is going to be good, and those guys are going to build something that is going to last and not blow up or catch on fire. China, on the other hand, not so much. When you look at how they've had the Made in China 2025, the pivot to build more refining capacity, they did. Unfortunately, they've had a ton of industrial accidents. They've had a ton of shutdowns. They've never really gotten to the levels that we expected them to get to. And let's be fair, it's still a communist country. They still put up export quotas, and we relied on them. And now when you look at the shortages, it continues to persist. And then the problem also comes from the lack of that crude that is being sought after in the international markets.
What's the typical sort of time to get a refinery up? Right. I mean, I think people are under the impression that you can just do this in a crisis overnight, but obviously there's a lead time to it.
Yeah. So if you think about so the last time in the U.S. a refiner was built, they broke ground in 1974 and it was completed in 1978. If you're doing a brownfield, which just means you're building it within the current fence line, you're adding a new piece to the process, it can be anywhere between 18 to 24 months, depending on the complexity. But if you were to build a brand new refiner from scratch, you're not in Brazil, where I think after 10 years, they're only halfway done with a 60,000 barrel a day facility. Typically, you're looking at 4 to 6 years, depending on complexity. And for those that don't know refining, it's called the Nielsen complexity. And it's just, what is the processing that you're using? If you have a coker is something where you essentially pre-treat the oil, because a coker is something where you're going to put Canadian oil sands. You're going to put the big, the thick viscosity things that have a lot of sludge in it, because you have to cook it first, you have to break it down, and that increases your complexity, which increases your lead time, because you have to have multiple steps. So depending on that is why you kind of have that broad range of an additional 24 months, from, let's call it, 4 years to 6 years.
So one of the things that I think you can argue is perplexing to some people is that we've had a pretty nice start to the year for equities, but the reality is oil equipment services, they haven't really done all that much. So as much as I've been saying melt up myself in my own analysis, it's another example of why the opportunity set matters. You haven't really had a continuation of the strength that we saw throughout last year, and that's despite the reopening of China and expectations that oil would pick up, commodity demand would pick up. You're almost seeing, I think, the opposite in price action. I'm curious to hear your thoughts on why that is. Is this one of those things where it's already priced in? Are there other dynamics that are confusing the issue?
Sure. There's different pieces to that puzzle. So we can talk about the U.S. first. So the U.S. is short equipment. So one of the things that I do with Primary Vision, where we have the frac spread count, where we look at the active completion crews. So a frac spread is the actual horsepower that shows up to fracture the well. The problem is, we're short labor, we're still short pipe, and we just don't have enough equipment to really roll out. So the inflation is real in the oil patch. So when you look at the inflationary side, there's really no impetus for an E&P to run out there and pay this big premium. The other side of it, even if the E&P wanted to, does the equipment exist? So if you think about 2019 into 2020, we had close to 500 spreads, sitting in the world, in the U.S. The problem was then a lot of this went and sat in a yard for a long period of time. And let's be fair, plastic and metal that isn't treated properly doesn't do that well baking in the sun and dealing with the freezing and thawing aspects of some of this. So you had a lot of this attrition of equipment. So right now we only have about 325 spreads. Things are fairly tight, and that inflation is coming down and biting some of these E&Ps and oil field services. And National Oil Well Varco, or NOVE, they gave some pretty cautious guidance, in my opinion, in terms of who's ordering, where are they ordering, and that's going to create some of this backstop where we'll only get to maybe about 350 spreads in the U.S. and we're assuming active spread counts of about 320 at peak in the middle of summer, which puts us to about 12.7 to 12.8 million barrels a day of production, which again is a lot of that's going to be exported. The U.S. refiners are pretty much tapped out for the amount of light crude. So that's where those dynamics of compressed margin and a lot of, as you said, some of it baked in, which is working against the U.S. refiner. Now, on the crude front, when you go abroad, everyone looks at China's reopening like, oh, China's reopening, it's going to be this huge surge. It's like, but is it going to be a surge? How much were they buying while they were closed down, while there was a lockdown? And what are going to be the ramifications of them turning back on? So when you look at the market in general, the light distillate market or the gasoline market is grossly oversupplied. So the middle distillate market, or diesel, is really the only thing supporting crack spreads, which a crack spread is how a refiner makes money. Now, the Asian refiners are struggling because not only do you have Chinese product coming into the market, you now have a surge of Russian product coming into the market. So they're seeing their crack spreads diminish on the middle distillate side. So they're sitting there and going, well, I can't compete against this discounted Russian gas oil. I'm going to have to cut my runs. I'm going to have to reduce my oil purchasing. So while China's ramping up a bit more, buying a few extra barrels, you have Asian refiners actually slowing down a bit. So you're seeing this kind of counter back and forth, and that's why I think, and personally, crude prices are going to be very range bound because the narrative is going to be who's driving the narrative right now. Is it going to be the China's reopening and demand, or is it going to be the fact that there's excess barrels in the market in the floating storage world? And these other pieces of the energy puzzle are going to stay expensive, which leads down into the farmer, the movement of product and the underlying supply chain having that inflation baked in.
Game it out for me. I'm curious to hear your thoughts on this. I've made this argument that if somehow this year we see a full-on ceasefire and the war stops between Russia and Ukraine, that could be very, very bearish for the energy complex. And I say that because that you kind of allude to it. You'd see conceivably a flooding of new supply when everybody's expecting that this war gets drawn out for some time. Am I wrong on that idea that the reaction to Russia stopping Ukraine would be quite bearish, at least short term, for the space?
Yeah, it would be a very bearish shot to the arm for sure, because you would get, obviously Nord Stream is gone, so you wouldn't get piped gas happening to the same degree. That would sit in the way of some of that growth, but you would get product moving back in. And then the question is going to become how much lost production happened in Russia, because right now Russia can't risk turning any facility off. So they've struggled to keep things turned on, but they usually get intellectual property from the U.S., from Germany, from Taiwan, a lot of these key areas for not only chips, but top drives and other pieces. So I think the instant reaction, I would sell everything and you would ride that baby down $8 to $10. But then I think people would have to take a step back and look at how much lost production is there. Are sanctions actually lifted? Is Germany sending in new people? Is Schlumberger and Halliburton re-entering Russia to bring production back online? So I think there would be a little bit of that longer term, or medium to longer term of, well, how quickly can we get back to normal? And that's on the energy front. If you look at the crop side, it's a little bit different, just because there's been so much damage to the infrastructure around potash mines and around some of the equipment to get stuff over, where you would get an instantaneous move in all commodities, but I would be more apt to buy the dip in some of the fertilizer side. And I think K&S had the CEO did a great job of kind of outlining how impacted Russia and Belarus are from a potash perspective. And then you have to look at the land. Did we miss the planting season? Did we miss putting down fertilizer? So even if there's a ceasefire, do we actually have enough grain, wheat and corn and sunflowers planted to fill the void? Or are we going to have one more year of a really bearish, I should say, bullish pricing, bearish the amount of product available in the market? And that's going to be where we'd have to go in and see what that looks like.
Yeah, and I believe fertilizer prices have correct me if I'm wrong, they've stabilized a bit, right? They had a sizable decline, and then looks like they're kind of hanging in there. There is a leading aspect to fertilizer prices and food prices that I've seen, meaning fertilizer tends to move first, then food with a lag. So it sounds to me like, from what you're saying, that regardless of that outcome, which would be good from a geopolitical perspective, we still are in sort of a higher average pricing environment for food prices.
Absolutely, and as you pointed out, with fertilizer prices, you've had, just look at Europe. You had natural gas prices come down a bit because it's been a warmer winter. You've had ammonia prices come down, so you've had some, electricity prices. So you're coming down to a point, but then you kind of flatline because we're in a fairly, the seasonal lull for fertilizer purchasing. Typically that picks back up as you go into March and April. And when you look at, Germany and Europe, yes, prices have come down, but then as they come into their shoulder season and they look to refill the coffers heading into summer, well, they had the benefit of the November, December, January of still pulling in piped Russian gas. And now a lot of that is gone. So you're turning to the LNG market, which is just going to have a higher cost. So as you said, that you kind of come down and then you level off a bit. And instead of coming back down to normal, you're re-rating at a different level, which is going to then increase pricing. But then a lot of the farmers rely on bonds. They rely on borrowing to go buy seed and fertilizer, and rates are higher. So that increases their cost in general as well. So you see a re-rating where things have come down, but we're not going back to where we were. So there's no real replacement, which is the underlying problem with some of the green movement, where it's like, oh, we're going to replace diesel. It's like, great, with what? Oh, I don't know, but we're going to replace it. Okay, at what price? So when you look at the underlying floating market, there's always going to be a buyer and a seller. The question is, where do you cross? And when you look at the demand cycle, there are natural impediments to movement, where in the US, you are going on Colonial Pipeline. For those that remember the Colonial Pipeline, that was the thing that was hacked when they shut it down for almost 2 weeks, and there was a panic all around the East Coast. So you're either going on the Colonial Pipeline or you're coming from the international market. Now, the problem in the US is we can't easily go from the Houston harbor to New York harbor because of the Jones Act. The Jones Act says that a vessel has to be built, manned, and flagged in the United States to go from one U.S. harbor to another. So this now pushes you into the international market. So there's no easy replacement because of the isolated nature of the US. So you have trucking. Trucking is not going off of diesel anytime soon, even though California wants them to, and they're trying to ban, any or they did ban any truck that's older than 20 years. But at the same time, you have this limitation on heating oil. So based on all of the regulations that have come out, heating oil has essentially become road diesel based on the sulfur components. And based on the locations of these entities, it's difficult to get natural gas and propane into them. So you have a beholden buyer where even though you have higher pricing, it's going to be very difficult to replace a lot of this demand. So longer term, we're going to rely more aggressively on the floating market and less on ourselves, putting us at the essentially at the mercy even further to the Middle East and realistically India to send us product, and then South Korea and Japan trying to absorb into the West Coast or Pad 5. So, and it's there over time, we should find ways to replace it as things get more efficient, but it's not going to be quick and easy, and it's going to result in excessive pricing, which is why that stagflationary backdrop is going to remain in the supply chain. So I think it's a great safe play, especially when the conversion. So if you remember back in 2013, 2014, everybody was selfish. Everybody wanted what's called POP, or percentage of proceeds. So it said that not only will I move your product, but I want a percentage of what I sell it for. And when prices were going to the moon, everybody was like, sure, take what you want. But as 2014 led into 2015 and everything collapsed, well, everybody wanted to go back to being a toll road. And when you're looking at the tolling fee, it's just a matter of, you're collecting and clipping a coupon every time you move a barrel, regardless of the price. Oil could be $100. Oil could be negative $34. You're still collecting $1. Now, because a lot of those conversions happened in 15 and 16, and as volumes have stabilized and increased in some areas, now you're getting a benefit for moving this product, but you have a very stable cash flow. Now, to bring that to the next level, I like guys that have access to the export markets. Because when you look at the export market, especially on natural gas liquids, which is ethane, propane, butane, and for those that are paying attention, propane and butane are merged into what's called liquefied petroleum gas, or LPG, and that's exported into the market. Now, as we talked earlier about some of the build outs, well, China has been building a lot of ethane capacity, a lot of petrochemical capacity. And when you do that, you're beholden to keeping these operational to cover your fixed costs, regardless of how the market looks. So there is a big demand for plastics, just based on the EV side, based on this new petrochemical capacity. So NGLs are going to continue to flow off our coast. And that is a nice little tailwind and little uplift to earnings. So I think pipelines are a very good play, especially guys that can take from the pipeline, have a little bit of processing, and put it on a boat themselves and send it into the global market.
Let's go into the macro a little bit, Mark. Just I'm curious to hear your thoughts on where we are in the cycle. Powell seemingly wants to put that narrative out there pretty strongly that disinflation's begun, that we're going to start seeing the lagged effects of higher rates start to factor through now. Maybe that's why equities are higher. Maybe it's because everyone was convinced they would only go lower. Right? You never really know, except with hindsight, why stocks do what they do. But where are we? I know you've mentioned stagflation a few times, but it seems to me that there's still a bigger risk of outright deflation, which I know is not a very popular opinion. But you do have a lot of loans that roll over next year. Credit crises tend to be deflationary shocks, and the Fed may have to get ahead of that by simply trying to talk down inflation uh, just so that they can get ahead of that for a pivot themselves. What are your thoughts on that overall?
So back when in 2020, I put together this view that we were in a weird amalgamation of the 30s and 70s, and that we were going to see massive inflation lead into stagflation and then convert into some fairly steep deflation. And I think we're in a stagflationary backdrop right now. And the reason why I say that is because you have miles per ton going up, you have costs going up across the supply chain because of diesel, because of these other pieces. But the other one is service cost. And the problem when you look at is sticky inflation versus flexible inflation. So flexible inflation is going to dance. Like we know that electricity prices are going to go up and down, gasoline prices are going to go up and down. But the sticky side, service cost, rent, healthcare, these are things. A home. I'm sorry, childcare. Anybody out there who has a kid in school or whatnot, those things have gone up, and they're not coming down quickly. And when you look at the most recent PMI data, you're still at over 67.5 for pricing, which it's well below the 75 or 78 that we peaked at, but you're still seeing an expansion on the service center. So if you think about the US economy, 70% service, 30% manufacturing, you have a little bit of that stickiness that is pervasive on that front. Then you take it to the next level and you look at wages. Wages are falling, but the cost per level of production is actually staying fairly sticky because there's a certain amount of incentive you need to provide people to come in and work. You know, what's it called? The activity rate, the amount of people that are actively looking for work, the participation rate currently sitting at 67.4%, very low versus historics. You know, you're looking at a fairly tight jobs market, even though we shouldn't be. You know, we still had, I think the most recent retirement, excess retirement is like 1.7 million. So you have this weird dynamic right now of deflationary pieces of manufacturing, durable goods. All of those prices are coming down, but the service side and the cost side on production is remaining fairly sticky, and that's why I think you'll see headline deflation, but you're going to see core inflation remain elevated, which is why I think you get that stagflationary backdrop. Now, fast forward a bit, and because I do agree with your deflationary view as we go into next year, you also have this move on nearshoring and onshoring. I'm sure everyone's heard it, multiple times. If you look at what we've done from the 60s, 70s, early 80s, we exported inflation. You know, we were shutting down facilities. We were exporting manufacturing and building it in Japan. We were building it in Korea, as we moved into the 80s and 90s into China. So that brought down our inflation because we were importing deflation. Now, as we look to secure our supply lines, secure our supply chain, we're going to bring back some of this manufacturing. We're going to bring back some of this equipment, which is going to be inherently inflationary because you have to build it, you have to man it, and the production. I think what is it? The average Chinese worker is 40% less efficient than a U.S. Employee. So there's a certain amount of gains that's going to come from that. And then when you build it new, it'll have more automation, bring down costs over the long term, but you're going to have a little bit of that shock that's going to come through as you build out some of those new facilities, which is, again, keeping, I think, some of that stagflation a little bit longer before we get some more of that deflationary backdrop.
I know everyone, and I don't disagree with it, makes that point that services are sticky on the inflation side, but that's got to be more than just something that's happened post COVID. To me, it's always goes back to competition, right? I mean, you wouldn't have sticky services inflation if you had more companies competing to lower prices and just bringing things kind of back in line from the way things are supposed to work from a competition standpoint. Um, but you can't really get competition unless you have lower rates to encourage more entrepreneurialism. I'm curious how you square that circle. I mean, it's you know, you need to bring these prices lower. You can't do that unless you have more entrants, more players. You can't really have more entrants, more players when the cost of capital is high to break the very inflation that services are supposed to are pushing into the system. You see what I'm saying? It's an odd argument, I think.
Well, and it's interesting because when you look at the lack of and the liquidity, and we created almost what we had if you go back to the later 1800s, early 1900s with the robber barons. When you look at what the robber barons did, they increased the efficiency of travel of the supply chain. And they sped it up in terms of now having our own diesel, having our own steel, having our own rail, all of these things. And they created these vast empires. And if you look at something similar, when you look at Google, you look at Amazon, you look at the services side, which realistically, they've streamlined the supply chain further, but in a slightly different way on information. And you've had this essentially glutting, and you've had this streamline where you have your new robber barons, which have helped kind of stifle and or buy up competition quickly. So the other side of the equation is, yes, you need lower rates to bring things, but you don't need free rates with free liquidity, because then you create a gluttony and the zombie corporations, because you now have this money that is going into a corporation that is just cycling through debt, but never actually going cash flow positive and can't actually stand on its own 2 feet. And when you have a hurdle rate that's so low, well, who cares? And as they proudly pronounced at Davos, I believe it was in the end of 2019, that they fixed the business cycle. It's like, but why? The business cycle provides opportunity because you then have people recycling bad debt, poor decisions that they made into new companies that might have a different future. And instead of having this constant rebirth and recycle, we try to then stymie this movement, which then created and resulted in a slowdown in the income mobility, the economic growth that an individual can achieve. Because to your point, you've had this tightening of competition where there isn't any. So who am I going to go to? Verizon or AT&T? All right, well, who else? Now you're beholden to these behemoths, and they have all the pricing power, and it doesn't matter because I can't deviate from them. So now my costs go up, my ability to hire is diminished, my ability to then go out and create is impeded by that. And you need to have some of that rebirth, which is why I think we need down cycles, why we need to have higher rates, because you're going to look at that money differently, and you're going to do different levels of due diligence that is going to drive and I think promote more cash flow heavy product versus something that's just going to sit there and churn and burn cash.
Right, and of course, if you eliminate some zombie companies, then you're even reducing competition further. I mean, that's kind of the bizarre state of affairs that we're in. I shared the Nest chart that's been going around, but it's true. There is a large number of loans that need to be refinanced next year, which hint hint everybody is why I keep saying I think there's a credit event out there, independent of the melt up, which we can debate if it's continuing or not. But most crises, Michael Howell of Cross Border Capital makes this a point, are refinancing crises. So the fact that Powell a couple of days ago said that he expects inflation to be running at 2% in 2024. To me, that's him kind of front running the realization on the Fed's end that they're going to have to cut rates in advance of that tsunami of loans that has to be refinanced. So, the question then becomes, from your vantage point, Mark, uh, if there is a credit event, we know credit events tend to be pretty nasty for everything. Um, do you think the oil and gas space would be more isolated because now there's more attention on the needs in terms of refining infrastructure, all this stuff, or is it going to be one of those correlations go to one again?
All correlations go to one in a credit event like that. But I think they're in a much better position from a cash flow perspective, from a debt perspective, than they've ever have been. Because if you think about like 2013 into 2014, everybody was buying acreage. Permian acreage was going from 26,000 to 48,000 to $57,000 an acre, and they were just gunning and saying, oh, well, I can get the debt on that. But now you've come into more of a manufacturing mode where they've it's repeatable. They know how many rigs they need. They know how many completion crews they need. They know the bogey they need to hit to maintain their decline curves, to maintain the profitability. So I do think they're in a much better position. From your point on zombie companies, it's true where you'll reduce some of the competition, but you also give rise to new competition. And typically, and the beauty of America, the most amount of new patents filed and new companies created comes in downturns, not in at the tops. So typically, people they like to tinker, and they tinker in their basement or in their garage, and they come up with something new and innovative. And if you think about server space and the ability to get it's still fairly cheap. It's very commoditized. So I think some of the zombie companies that are just draining assets, not to pick on crypto, but as you saw with FTX, as you've seen with some of these other, .com type level of, I don't want to call it fraud, but just absorbing assets that can be redirected to something that can have a cash flowing future. I think that would then breed more competition in the long term as you get a more realistic hurdle rate. Like, for an example, if you look at Apple. So if you tell Apple, you have $500 billion on your balance sheet, you can either take 100 billion of it and replace the microchip. Just replace the microchip. Well, I don't know what it is, but hire 50 scientists, give out all these grants, give out all these other things to replace the microchip, or turn around and leverage your balance sheet, buy back stock. Well, which one is going to position my company better for the future? Which one is going to create a new industry, a new growth prospect that other people can then piggyback off of and create their own products off of that kind of technology? And that's why you've seen this stagnating view in terms of, why do R&D? I'm just going to leverage my balance sheet and buy back stock because I'll get rewarded. My stock gets better, and then I'll retire before I have to worry about the growth of my company. It's coming back online right around shoulder season. So you won't get the uplift that you would have gotten if it came on in December. So it left about 1 million tons on shore. If you look at just the underlying flows, it should be back up and operational. They've already requested from FERC to start freezing start the freezing process and starting to get that up operational. Based on the mass of current LNG flows, it's going to find a home in Europe, and it'll help alleviate some of the issues on the refill during shoulder season prior to heading into summer. But it's just gonna pull more product off the coast. I think I selfishly speaking, I'd want to say that you want to buy gas here because I think it's a little cheap. But realistically, I think that you're going to get a little bit of a stabilization, and it'll be a benefit for the Europeans as they come back online. The bigger benefit is going to be when the other facilities turn on. Golden Pass is slated to come on soon. You have the expansion when you look at Port Arthur. So there's definitely some opportunity with about 6 million tons per annum, expected to come on in the next 2 years, which will also not only support Europe, but help stabilize our market and keep us, I think, between a fairly healthy $3 to $4 range on average, taking out obviously the peaks and valleys during shoulder seasons and peak seasons. Well, and you saw it in India where they threw up gates to protect exports on rice and wheat. And then they turned around at the end of January and released over 3 million tons of wheat from their strategic reserves because you had food inflation getting to such an aggressive level. And when you look at inflation and how it hits people differently, the middle class and the poor get hit the hardest. Like the UN just put out their world food pricing update, which is always a great read because you see how it really impacts the middle of the pack countries all the way down to the poor countries at a growing rate. So as you have pricing go up and without any real way to stop it, And because a lot of these countries have exasperated all of their fiscal support, all of their monetary support in 2020 and 2021, they're going to have to let some of this product free float. And that's going to create more polarization as people get angry. People don't have the ability to feed their family. And when you look at the U.S., for an example, so the U.S. went from out of every dollar, about 17 cents to 24 cents being spent on food, to anywhere between 30 to 34 cents being spent on food. Now, that's the U.S., and that was back in 2019. In 2019, the average emerging market was spending, or the average emerging market citizen was spending 87 cents per dollar on food. So when you think about how that has gotten stretched to such a point, you're going to have this period of I can no longer replace. Like to your point, you have to think about the flows, right? So cow is the most expensive. Then you have pig, then you have chicken, then you have fish. The problem is we've been overfishing with the real problem starting to come to light in 2009 and only progressively getting worse. So what happens? We grow more, we raise more chickens, we raise more pigs. Well, what does that do? Well, you stack all of these critters together, and what do? You have more prevalence of swine flu. You have more prevalence of bird flu. So now to Gary's point, and then to Michael's point on the period of without having diversification, you're creating these behemoths that now make things more and more inelastic and supply chains more fragile. So then, which is where we sit today. So now, if you take it to the grain side, beans are the most expensive, then you have corn, then you have wheat, then you have rice, and you'll keep moving down that scale till you're at your lowest point. And as the lowest common denominator gets more and more expensive, you price people out of the market and you try to find alternatives. The problem is we have been over fertilizing the soil. We have been damaging the soil for 40 plus years. So every new incremental chemical, it will then have a negative impact. So you have this chemistry equation that you need to figure out of how much fertilizer can I get put down before I burn the root system. And if you look in China, they reached that level between 2016 and 2018, and now they've actually had a big decline in some of their production. When you look at the US, we haven't really done much on yield since 2012. It's gone up and down, but between 2012 and today, we haven't had much increase in terms of flow. La Nina, and I always think of El Nino with Chris Farley whenever I talk about it, but La Nina is impacting Argentine and Brazilian crops exponentially, which is creating more softness and more problems in terms of the availability. And we're at a point now where more fertilizer doesn't fix it. They'll try, and that'll create, I think, a short-term pop, because if you use more nitrogen, you'll benefit in the near term. But it's more of a one-off than it is a long-term solution. Well, and it's interesting because I never want to discount the poor in the U.S. because it's still a terrible thing that we need to address. But poor in the U.S. and poor in Nigeria and Angola and some of these other places is vastly different. And there's this sometimes it's very easy to be myopic when you look at the U.S. and where we're positioned, and forget those impacts that you're seeing in real time, and you're talking about someone who is fairly well off in terms of college educated and job. Take a step out 100 miles from the city center, and how bad does it get, and how quickly does it get that problematic, which is why you have this growing polarization in the world. You're having this growing, isolationist view, because it's like, well, we need to protect our own first, because we need to make sure we can feed ourselves, that we make food available for ourselves. And then that then moves to another level on the credit side, because I do think there is a big credit event coming. I think there is Gary and I have spoken about Japan, the BOJ, and kind of the ending of this MMT experiment, and it's going to be damaging for these countries that are don't have the ability to go out and just borrow and hope things get better. Argentina's gone bankrupt how many times at this point? I think by the time my friend left Morgan, which was about 10 years after I did, we were still fighting because we owned CDSs on the Argentine debt that we said was going to go bankrupt, and then they did, but ISDA was trying to find a way to screw us. So when you look at some of the different pieces, like there is a problem in the credit markets that is just beneath the surface. I think China is showing you the problems that are really sitting there. For every dollar made in GDP, they had to borrow 3.5, and that is not a sustainable situation. Now, when you and Michael, you talked about the big credit roll. Well, we're running a twin deficit of over 8%, and now as we continue to roll our debt, as we continue to not only roll our debt but issue more debt to cover our own spending, who is the buyer of last resort? And whenever I come back to anything, I want to know who is my buyer of last resort. We know from 2008 to 2020, it was a mixture between Japan and China. They're now gone. Then it became the Fed, and they were the last buyer of resort. But now they're tapped out. And to your point on wages and where things are, a wage spiral is the last thing that the Fed wants. And as much as I don't like Powell, I think he's a very smart individual. And when you compare, and for some reason people like to stop their charts at 1981, but you really have to go back to the 1970s. And if you look at what happened when they raised rates from 75 into 76, they brought inflation back down, but then in 77, they started cutting aggressively. And then they cut aggressively, and then in 78, they were very slow to raise rates, and you had a wage price spiral. Now, that created a whole slew of other problems, which then created this spiraling inflation that Volcker came into and had to go well above where he wanted to. And, if you go back and ask him, he wishes he stopped at 19%, 17 to 19%, not going to 22. But that's something that they want to avoid. So how do you avoid that? Well, you get to 5.25 fairly quickly. But the Taylor rule is telling us we should be at 7.5%. So he's telling us, I'm not going to get you to 7.5%. I don't need to get there, but I'm going to sit here at 5.25 until we can bring things back under control, because the last thing they want is a redo of the 1970s and cutting too soon to create a wage price spiral. I think he'd rather sit there longer than he wants than cutting sooner, because the damage of an early cut is, I think, greater than one cutting later, than cutting, waiting to cut longer.
By the way, I think some people dropped off when you said that Powell is actually smart. Just something I noticed.
It's possible. I'm trying. I try to be as political and take the personal view out of it and just look at the economics and data sets behind it.
Dude, I'm with you. I have to tell you, like, I'm not a fan of the Fed and policies that they've done, but it's like it drives me crazy. People on FinTwit think they know more about what's going to happen next than the Federal Reserve, which has more models than anybody else. And by the way, they can't predict the future either. It's like, come on. I mean, we're all trying to deal with the unknowable tomorrow, right? I think that's kind of the point. Anyway, folks, I have to hop. I'm doing another space tonight at 9 p.m. with, as I keep referencing him, the most powerful man in federal cannabis reform. I encourage everybody to join that. That's going to be a really powerful conversation. I'm quite excited for that one. Todd Harrison is going to be joining. Weldon himself, of course. Please make sure here, everybody, you follow Mark, follow Gary. I'm going to have this as an edited podcast. This is, I think, my 270th space of the day, so I'm a little bit burnt out. I'm going to get my energy up. But thank you, Mark. Appreciate your knowledge and spending the hour with us.
It was a pleasure. Thanks for having me.
Thank you, everybody. Cheers.